My Tedeschi Wealth Management Advisor at Perspective Wealth Planning. With this week's market breakdown video, we are going to take a look at the four major U.S. indexes. We're going to take a deep dive in on what's going on with the emerging markets. We're also going to take a look at the U.S. dollar and commodities, but we're going to pay very close attention in this week's video to breadth and some major key levels that we're kind of approaching here on a lot of the indexes. First, let's start with the S&P 500. When we just look at the S&P 500 here, there really isn't anything too concerning about what's going on. We are still in an uptrend. We have higher lows in place. We just made a new high. We're trading in this nice upward channel. But as I'm putting this video together Thursday before the bell, we are actually sitting right on that 50-day moving average. Blue line here is the 50-day, and the purple line is the 200-day moving average. I usually don't have them on the chart, but it's going to come up as important in a couple of the charts that we're taking a look at. So the S&P 500 does look fine at the moment. However, when we start looking at some of the other indexes, things change a little bit. Now, first we'll look at the Dow. The Dow is actually stronger than the S&P 500. It's well above its previous breakout spot from back in on the 10th. Continues to hold up much better than the rest of the market. And we've seen that kind of flight to safety into those bigger stalwarts into value, and we've talked about that here over the last few weeks worth of videos. So the Dow, the S&P 500 are not super concerning at this point in time. But when we look at the Nasdaq, that story changes a bit. Here is the Nasdaq. Now we have a lot of lines on the chart that we've drawn over the last few videos. You can see that we have a resistance level up here at this 13,300 zone, and we got our support down here at this 12,250 level, and we've been trading inside of this. Now what has happened during this time frame is we've fallen below this 50-day moving average, and we have stayed under it. And now the 50-day moving average is starting to turn down. Okay, so what we're looking at right here is a resistance point that we're not getting above. We're trading below a 50-day moving average, which is declining. We haven't traded below a declining 50-day moving average the entire run-up since back in here. We've fallen under the 50-day moving average a couple of times, but it wasn't declining the way that it's starting to right now. Now, it gets even worse when we take a look at the Russell. The Russell broke out and made a new high 2 weeks ago, and it sharply reversed that. We have fallen under the 50-day moving average, and we are actually pre-market here down another % this morning on Thursday to about right here. If we fall any further, we take out this low, and then we go from a new high to making a lower low within a short time frame. That is a classic potential reversal where you have a false breakout and then a swift move in the opposite direction. All right, that is my biggest concern right here when I'm looking at the indexes, that this was a false breakout and that we continue to roll over here. Now the Russell's still up nicely year to date. All right, it is still up even with the fact that it's dropped 12% in the last 2 weeks. It's still up. It's almost 8% for the year. So it is still a stronger index, but as soon as we start making lower lows, those uptrends go out. Remember, there's three things that a market can do. A market can be going up, a market can be going down, and it can be going sideways. Right? Those are the three ways that markets can behave. An uptrend is defined as higher lows and higher highs. All right? As long as that is in place, you have an uptrend. A downtrend is the opposite. It is lower highs and lower lows like we had last year. All right, and then you have that mixed bag where you have higher highs and lower lows, and that's where markets get sloppy. And so if the Russell takes this out right here, that true uptrend that's been in place breaks, and all of a sudden we enter a choppy market where we have a lower low and a higher high, and then that is always where things are the toughest from a technical standpoint. And so you'll really have to wait to see how that ultimately plays out. So we're not at the end of the world at this moment. We've talked a lot about some of the reasons why the market might run into some issues here over the last few weeks. There have been a lot of things underneath the surface, but we still have the S&P 500 holding on. We still have technically higher lows in there. We still have the Dow holding above its breakout spot from before. So we don't have to worry too much, but things are starting to look like we could get that turn, and we have seen some breadth readings here as of late that are starting to get a little bit concerning. Now, we've talked about this a lot. The Nasdaq McCullough Summation Index, which is taking a look at new highs versus new lows. You can see here since February we have headed lower. And what we really look for in this chart is when we get our crossover, and a crossover being the Nasdaq McCullough Summation Index, and then we have a moving average of 4 on it. And when we get a crossover like we do right here, that's a tailwind. This is a tailwind. This is a headwind here. All right, this is a headwind. And stocks tend to follow this pretty well because this is looking at breadth. It's looking at new highs versus new lows. Well, we were falling, and now we turned back over again in the last couple of sessions, and it looks like we're headed back towards this zero line. It's very important that this stays above zero. And if it doesn't stay above zero, that's when we start getting concerned. And another way that we can look at this information is by looking at the total New York Stock Exchange new highs versus lows index, and we can actually see we flipped below zero this week. There were more 52-week lows than 52-week highs. We cracked below that zero for the first time in quite some time. Now, when we look at this, annualized returns, if we are above 0%, we have an annualized return of about 11%, and we're positive almost 2/3 of the time. When we are below that 0%, our annualized return is only 4%, and we are only positive 1/3 of the time. And that makes sense. If the market is making more new lows than new highs, that would not be good. Okay, and that is what we're really starting to pay attention to here, is the breadth underneath of the surface. Now, I said we'd also take a look at the emerging markets. The emerging markets have now entered a correction phase here over the last couple of weeks. They made a new 3-year high and then dropped more than 10%. That's what we're looking at. When we look at our positivity rate for that going out all the way back into the 1980s, we're only positive a year later 53% of the time. So below your average return. And we are negatively skewed for the next 3 months consistently, with some major pullbacks in there along the way. This goes to what I was talking with on the Russell. A lot of times when we get that false breakout, those are the sharpest moves in the opposite direction. And we can think about what's actually going on here on something like this if this were to continue to break down. Let's look at it from a psychological perspective. You get this move up here. You get buyers going, everything looks good, and they jump in, but they're the last of the buyers. There isn't any more left. And what happens is all of a sudden the sellers start selling in here, and the buyers just essentially have dried up because the buyers have used a lot of ammunition buying previous breakouts over and over and over again. The more breakouts we have, the more likelihood that eventually they're going to fail. Those first breakouts usually have a very strong success rate. The 5th or 6th or 7th breakout in a move tends to have a smaller success rate. You get to a point where you make that new high and everybody that's wanted to buy essentially now has gotten in, and you get that reversal. And so when we look at the data for the emerging markets, you see them make a new 3-year high and then have a 10% correction. That means they've gone from a high to, oh no, a correctionary phase. That gives you the we could be reversing kind of mindset, and you can see that from the data points as well. Now, when we start looking at a couple of other things that I want to jump in here and take a look at, let's look at the U.S. dollar. All right, the U.S. dollar, and this is the reason I have the 200-day moving average on here. I wanted to show you guys this. Here's a declining 200-day moving average. The U.S. dollar has stayed under that the whole time. It is right into that spot where it could make that push and be over the 200-day moving average for the first time in basically a year. That would be a change. Now, we looked at, and I'm going to remove those off of here now so that we have those clean charts. We looked at this being a very key important low level on a multi-decade chart, right? This goes all the way back to 2000 here. This support zone for the dollar was very, very important. So far it is held, and now it looks like it's trying to get up over that 200-day moving average and maybe put in that kind of reversal bottom. It's not quite confirmed yet, but it's starting to look more and more like it wants to do that. Gold still holding up over its support level. We're starting to see weaknesses in some of the other areas. Silver, which has held up extremely well, starting to see a little bit more weakness here over the last few sessions. This is kind of that last vestige of support until we get back to the major support at 22. Bulls really want to see silver hold on to that 24 zone here. Palladium has been very strong. It finally made that breakout over 2,500. It is now the best looking of the metals. Platinum is still holding over its breakout spot right around that 1,100 level, but this is starting to look weaker and weaker. Didn't kind of get that follow through here to the upside. And even copper, which has been really, really strong for a while, still off 10% or so from its high a few weeks ago, and is actually back under that $4 level. So we really need to pay attention to what happens there. Oil, which we talked about a lot, running into this 65 level resistance, has had a very strong reversal here over the last couple of sessions, and now is on the verge of potentially breaking back lower. But what I will point out to you is that we still have a series of higher lows going on. Sorry about that. We still have a series of higher lows in play in oil. So we have higher lows still. So we really need to take this zone out if this is going to be a reversal here in oil. So there's still some more room to give. It's had a very strong run for quite some time. Cooling off at a major resistance level is exactly what we said had a high probability of happening, and that looks like that's what's going on. So to kind of sum things up, when we look across the board, we still have a couple of indexes that are holding on. We've got the S&P 500 is still holding on. The Dow is still holding on, but we're really starting to see that weakness now in the Russell, right, which had been a leader to the downside for a while, so it's not as concerning as, let's say, the S&P 500 having a chart like the Russell, but it is starting to be a little bit concerning when we're seeing more areas of the market under pressure. We're seeing more areas of the market have those issues. We're seeing things like the emerging markets where we had some real good strength in the beginning of the year start to turn back down, right? The areas of expansion and breadth readings are starting to fall a bit, which of course always leads to a little bit of concern. We don't really need to change anything at this point in time, but if we see things fall a little bit further, for example, if the S&P 500 falls underneath that 3,700 level, that really starts to change the way that we have to think about this market. So, as always, I will keep you guys apprised of what is going on. And if you guys want to reach out to me and ask any questions, you can feel free to reach me at mtedeschi@perspectiveofplaying.com, or you can reach me at 814-580-9881. Ask me anything that you'd like to about the overall markets. As always, I hope you guys stay safe out there. I'll see you next week. Take care.